Hello, everyone, and welcome. I'm excited to have you here today. We're about to dive into an important topic, the accounting cycle. This is a fundamental concept for anyone studying business, especially BBA and BCom students. On this first slide, I just want to introduce the overview of what we'll be exploring, covering the main steps, the purpose behind the cycle, and the benefits it offers. Over the course of this presentation, we'll break down each part so you can understand how the accounting process works from start to finish. So, let's get started and explore the world of accounting together. Now, let's take a closer look at what we mean by the accounting cycle. Essentially, it's a series of steps that accountants follow to systematically handle financial transactions. These steps help ensure that every financial activity is accurately recorded, properly classified, and then reported in a clear and organized way. Think of it as a cycle, because once one process is complete, the next naturally follows, creating a continuous flow of financial information. You might also hear this called the accounting process, and that's because it's a standardized method used across businesses to maintain consistency and accuracy. By understanding this cycle, we're laying the foundation for grasping how financial statements are prepared and how businesses keep track of their financial health. It's really the backbone of accounting, making sure all financial data is captured and communicated properly. Now let's talk about the first step in the accounting cycle, transaction identification. This is where it all begins. Essentially, we're on the lookout for any financial activities that happen within the business. These include income, which is money coming in, expenses or money going out, as well as assets, which are resources the business owns, liabilities, meaning what it owes, and equity, or the owner's interest in the company. The key here is to recognize and capture every relevant transaction accurately, because these entries form the foundation of all the financial information that follows. Think of it as the starting point. If we miss or misclassify a transaction, it can affect the entire cycle later on. So, the main idea is to be vigilant in identifying every financial event that impacts the business. This step is crucial because it sets the stage for everything that comes next, ensuring our financial records are complete and accurate. Remember, thorough transaction identification helps us maintain reliable financial statements and make informed business decisions down the line. Now, moving on to the next steps in the accounting cycle, let's focus on recording transactions through journal entries. This is where we start translating everyday business activities into a formal record. When we make these entries, we use debits and credits to accurately reflect the financial impact of each transaction. Think of the journal as a detailed diary that captures every financial event as it happens. Once we've recorded these journal entries, the next step is to post them to the general ledger. This is a crucial step because the ledger consolidates all the transactions for each account, giving us a clear and organized view of the company's financial position. Essentially, the ledger transforms raw journal entries into a structured summary that we can analyze easily. Both of these steps, journal entries and ledger posting, are vital for maintaining accurate and organized financial records. They set the foundation for generating financial statements and ensuring the integrity of our accounting information. Connecting these steps to the overall theme, they demonstrate how meticulous record-keeping leads to reliable financial reporting, which is key for decision-making and maintaining trust with stakeholders. Now, moving on to the next steps in the accounting cycle. First, we have the trial balance. This is a crucial point because it helps us verify that our debits and credits are in balance after all the transactions have been recorded. Essentially, we're checking for any errors in our ledger entries before we move on to preparing financial statements. If the debits don't equal the credits, it signals that something's off, and we need to investigate where the mistake might be. Next, we come to adjusting entries. These are necessary to update our accounts for accruals, prepayments, and other adjustments that haven't been captured during the initial recording. Think of it as fine-tuning the financial records to reflect the true financial position of the business. For example, if we've earned revenue but haven't billed the customer yet, or if we've received an expense in advance, these adjustments ensure our financial statements are accurate and compliant with accounting principles. Connecting this to the overall theme, These steps are all about ensuring the integrity and accuracy of our financial data. The trial balance confirms that our books are balanced, and the adjusting entries refine our records to reflect the true economic activities of the period. Together, they help us produce reliable financial statements that stakeholders can trust. Now, let's move on to the next step in the accounting cycle: financial statement preparation. Once all the necessary transactions and adjustments have been recorded and processed, it's time to create the key reports that give us a clear picture of the company's financial health. First, there's the balance sheet. This report provides a snapshot of what the business owns, its assets, and what it owes, its liabilities, along with the owner's equity at a specific point in time. It's fundamental because it helps stakeholders understand the company's financial position. Next, we have the income statement, sometimes called the profit and loss statement. This shows how much revenue the company earned over a period, minus all expenses, to reveal the net income or loss. It's crucial for assessing profitability and operational performance. Finally, we have the cash flow statement. This report tracks the flow of cash in and out of the business across operating, investing, and financing activities. It's especially important because, while the income statement shows profitability, the cash flow statement reveals the company's liquidity and ability to meet its short-term obligations. Connecting this all back to the overall theme, these financial statements are the culmination of the entire accounting cycle. They communicate vital financial information to managers, investors, and other stakeholders, enabling informed decision-making. And that's why their accurate preparation is so essential in the accounting process. Now, let's move on to the next step in the accounting cycle: closing entries. This part is crucial because it helps us reset the temporary accounts, like revenues and expenses, so we can accurately track the next period's financial activity. Essentially, what we do here is transfer all the balances from these temporary accounts into a permanent account, typically the retained earnings or owner's equity. This process ensures that revenues and expenses don't carry over into the new period, keeping our financial statements clear and accurate. Once we've completed the closing entries, we need to perform a final check called the post-closing trial balance. This step is like a sanity check to make sure everything is balanced. We verify that the total debits equal the total credits after all closing entries have been made. This balance confirms that our accounts are in proper order and ready for the next accounting period. Connecting all these steps, closing entries and the trial balance are vital for maintaining accurate, up-to-date financial records. They help us ensure that our accounts reflect the true financial position of the business at the end of each period, setting the stage for accurate reporting moving forward. Now, let's talk about the purpose of the accounting cycle. At its core, the main goal is to ensure that all transactions are recorded accurately and reported properly. This isn't just about keeping numbers in order. It's about creating a clear, truthful picture of a company's financial activities. When done correctly, it helps us maintain reliable financial information, something that's essential for making informed decisions. Stakeholders like investors, creditors, and managers rely on this accurate data to assess the company's health and make strategic choices. So, the accounting cycle acts as the backbone of trustworthy financial reporting. It ensures that everyone who needs the information can depend on its accuracy, which ultimately supports transparency and confidence in the business. Connecting this to the overall theme, remember that a well-structured accounting cycle isn't just a process. It's the foundation for sound financial management and accountability. Now, let's look at some of the key benefits of implementing a solid accounting cycle. First, accurate financial reporting. When the cycle is properly followed, it helps ensure that all your financial statements are correct and trustworthy. This accuracy is crucial because stakeholders rely on this information to make informed decisions. Next, there's compliance. By adhering to established accounting standards and legal regulations, you reduce the risk of penalties or legal issues, and you maintain your company's integrity. It's about doing things the right way, every time. And finally, the cycle supports informed decision-making. When your financial data is timely and accurate, management and investors can make well-informed, data-driven decisions quickly. This ability to act swiftly based on reliable information is vital for staying competitive and planning for growth. Overall, these benefits underscore how a disciplined accounting cycle forms the backbone of transparent, compliant, and strategic financial management. And that brings us to the conclusion. The accounting cycle really is the backbone of good financial management. It ensures transparency by making sure all transactions are recorded clearly and systematically. Accuracy is at the core of this process, helping prevent errors that could lead to bigger issues down the line. And of course, compliance is essential. Following the right procedures keeps everything above board and aligned with regulations. Ultimately, the accounting cycle provides the reliable foundation needed to make informed decisions, plan for the future, and maintain trust with stakeholders. By understanding and applying this process, businesses can stay organized and achieve their financial goals more effectively.